Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up an interview with Todd Langford. He is the CEO and developer of the Truth Concepts Financial Calculator. So if you guys have ever seen one of our videos where we're actually going through the numbers, those are the calculators that he has created over the years, and we use those things every single day.
Yeah, great interview. And what stood out for me was he talks about how, safe places to store cash, and he goes into that putting money in life insurance is not an either or. We're not saying put the money in life insurance or real estate or your business, or like right now, maybe the stock market, that this is an and asset, that you can put it in your policy and real estate, your policy and your business, or and the stock market. He did a really good job on that. I will say one thing that I am disappointed at in this podcast.
Your hair?
You want to know what? That was good. I'm probably going to edit this out. But to be honest, I was, because the whole thing, I was off my haircut. So I look at the video and like my hair is a little bit off. Okay. But Cameron's dying here. But what I was upset about is my lack of skills in rock, paper, scissors. We had some questions. We always prepare a couple questions for the interview, but then some things always come up where we want to add an additional question. And Cameron and I each had a different question, but we had limited amount of time. So like any small, smart business owners or mature individuals, we did rock, paper, scissors to see who got the question. And Cameron won. So, but my question it is, can you lose money inside an IUL? We will have Todd back to fully answer that question more thoroughly. But I also, if you want to get that answer to that question, take a look at the podcast that we did on why. I think we called it why us and Batman do not like IULs for IBC. And in the show notes of there's actually a web page that you can go to actually see some of the numbers and the additional resources that we were referred to. Cameron, outside of my hair, what stood out for you on this podcast?
Todd, what we did here, you guys are going to hear pretty quick, is we went through the top 5 myths of financial planning. Todd is one of the most analytical individuals that I personally know, and he's got answers for everything. And so it's a great introduction to kind of this conversation that we're going to continue to expand on, IULs being one of them. And then the other piece that I'm really excited about doing a follow-up podcast to is the idea that he touched on, which is saving versus investing. Saving is kind of a verb, it's an action, and then investing is completely different. And even so, I want to give us an opportunity to define what speculating is. So there's 3 ideas that we've got to kind of define and then start to work through: saving versus investing versus speculating. And Todd kind of introduces us to that idea in this podcast. And so I really hope you guys enjoy it. This is called the top 5 myths of financial planning.
All right, Todd, we're going to jump right in, right? We appreciate you appreciate you joining us today. And we have not prepped you with any of these questions, but we do have the top 5 myths of financial planning. And so kind of what we're going to do is we're going to throw you the myth, and then we're just going to kind of start to get some feedback, and we'll engage from there. How's that sound?
Sounds great.
Perfect. So the first myth that we've got that we're going to discuss today is going to be buy term and invest the difference. Could you share your thoughts on that with our listeners?
Sure. And there's a couple of pieces to that. And I, one of the things that stands right out is everybody wants to talk about buy term and invest the difference. One of the unfortunate pieces of buy term and invest the difference, though, is it becomes buy term and spend the difference for a lot of people. And it's a discipline factor as much as anything. And it sounds good on the surface. Hey, I'm not going to buy that expensive whole life insurance, so I'm going to buy cheap term insurance and I'll take the different and invest it. Well, they never do invest the other piece is number one, because there's no discipline there, and that hurts it. But even if they did do the discipline part of actually saving the difference and investing it and doing other things, in most cases they've exposed themselves to some risk on that piece of it. And one of the big things that we talk about with whole life insurance is the guarantees, and having those bigger pieces that are guaranteed to happen instead of might happen out in the future if everything goes perfectly. And really, isn't that the point of insurance? I mean, to me, what does the word insure mean? It means to make happen, I think. You may have a different opinion on it, but for me, insure means to ensure that there's an outcome that's desirable. And so if you risk that portion, then to me, you're kind of undermining the whole insure part.
I agree 100%. When I think of the word insure, I think of transferring risk. Right. So instead of me carrying that risk, what I'm doing is I'm insuring it and I'm transferring it to a third party.
Absolutely, I agree completely. And so when we go down the road of buy term and invest the difference, we may be pushing that risk of the pure death, off to the insurance company. But now we're taking on the risk of what happens to that investment piece. And, for a lot of people, they think, well, I can do better in the marketplace than anywhere else. It is an interesting idea because everybody wants to quote the S&P. I want to say, hey, I could do 12% in the market. That's what the market's done for the last
year, 12%.
Yeah, I might do as low as 20%, right? But the reality is, when we look at some of the websites like Dalbar, for instance, and they keep a running total of what the real investor does, while everybody wants to quote the S&P at 12 or 13%, the real investor unfortunately does the opposite of what the S&P does, and that is they buy high and sell low. And so I don't know exactly what their running average is right now, but I think somewhere around 3.5% is what the actual investor does. How are you going to get ahead with that?
Just to explain this to our listeners and to Cameron, is like what the Dalbar does is they take really what the net people walk away with, right? After the expenses, and also, just as you'd mentioned, people sell, they sell low and they buy high, right? I mean, so what we will do is we will put a link to the Dalbar in the show notes. A very interesting independent article about the true returns that people get in the market.
Right, because I think the institutions, they have some advantage of being able to have some people that have really studied economics, and they understand what some of the ups and downs are, and so they're more tuned from the corporate side to be able to use the market probably in the right way. But the individual investor, they work totally out of emotion and fear, and the issue is, all of a sudden the market's going down, they're going to start selling and panic. And so they do the opposite, really, of what makes the institutional investors money. And so it's just the nature of the beast. And it's what people do just because of the way they're wired. And so to go against that grain is tough for people. And so, it all sounds good. Again, going back to the whole buy term and invest the difference. Why would I let an insurance company invest my money for me? It's because they're good at it. Okay. They
And a lot of times when you're talking about term insurance, is the word deal always comes up, right? Term is a better deal for me.
Right. It's a better deal. Yeah. Well, the thing about it is, when we look at insurance, the thing about insurance, and this is what I learned from my mentor, and if you can keep this in line. So Norman Baker taught me something when I just started getting into the business and started working with it. And what he told me was, early on, was there are no deals in the insurance industry And really, that's true to all of the insurance industry. What we're really focused on right now is the life insurance industry from that standpoint. But what it means really is everything is a trade-off for the insurance companies between risk and cost. And it's the same thing anywhere. And any kind of insurance works that way because they all have actuaries. And it's interesting, I think a lot of, just because people are used to hearing the word actuary related to death or mortality or those kind of things, they think a lot of times that actuaries work just on life expectancy. But actuaries are all about risk. It's risk mitigation for the insurance industry. So you have actuaries for whether it's property and casualty insurance, you're insuring a building, your car, your house, whatever else. There's all actuaries that figure out, okay, how many houses are going to burn in the next year? So what do we need to charge in premiums so that it covers all those? And we end up making a little bit of money to keep the insurance company profitable, which has to happen, or else there's no money there to pay those losses. So it's all about risk. And when we look at life insurance and we talk about risk, why is term insurance so cheap relative to, say, whole life insurance as far as what the premiums are?
Are you asking us?
Yeah, I'm asking you.
I wasn't sure that was rhetorical.
I thought he was going to answer Cameron, but if you want to think you can answer better than Todd.
Well, I don't think I can answer better than Todd, but I'll throw my answer out there. Is that based on my understanding, is I'd say because they take on less risk on the term product.
Right. There's almost no risk on the term insurance. That's the only reason they can make it so cheap, right? Because statistically, for someone who can qualify for the insurance, their chance of an early death is very, very low. So the insurance company has very little risk in that, and that's why they can charge a lower premium, because actuarially, this individual is not going to hit the actuarial curve where there's a likelihood of death when the insurance is still in force. Okay. And if we look at the total other end of the spectrum and we look at whole life insurance, why is the premium for whole life insurance so much higher? And the reason is because the insurance company is on the hook for your whole life. It is guaranteed to pay out. It will pay out even if you're alive and you hit currently age 121. So the insurance company will pay that claim. They might not and probably won't pay a term insurance claim. So when all that's put into the mix, term insurance is very cheap because the risk for the insurance company is low. And so everything falls into that category. And if we can keep that in line, really helps us be able to see when something comes forth and it's like, wow, this is half price of anything else. Okay, well, you better look at what the risk is involved in that, because that's going to tell you why it's half the price.
Get what you pay for, right?
You really do.
Yeah.
Karen might be surprised. I'm going to go a little bit off topic.
Wait, taxes?
No, it's not going to be about taxes.
Okay, good.
But I could, right? Are you going to be in a lower tax bracket? No, I'm just kidding. While we are talking about term insurance and death benefit, another thing we're told by typical financial planners is you don't need death benefit once you're 65 or once you retire. And I think a lot of people, that's what they think. What's your thought on that?
I agree with them completely. Okay. There is no traditional need for the insurance death benefit at that point in time. However, if you understand how it works, there may be a huge want for that death benefit at that point in time. So let's go back to what I'm talking about. So during the accumulation phase, and you've got somebody that is saving money, they're working to provide an income for their family or maybe just for themselves, but in the area where they're providing this income for their family, certainly in that environment, if something happened to them, is that family going to suffer with the loss of income all of a sudden? Yeah. So if this individual had plans for his children to go to this school or that school or whatever was in the future, they're going to want to make sure that happens even when they're gone, because it could be devastating to that family. And in fact, anybody who has seen somebody in that situation and how it changes their life, they have no idea what a death of a spouse or a parent is going to do to their ability to carry on. It can be dramatic. And so there is a pure need for that death benefit during that time frame to replace that income. And that's what the insurance companies use to determine how much death benefit somebody can get. You can't get more death benefit than you're worth, just like you can't get insurance on a building for more than the building's worth. Why? Because the insurance company would be on a risk that you might burn it down, right? So there's an economic value to a piece of property, and in the case of life insurance, is the economic human life value, which is calculated on a person's ability to earn an income. So what happens is there is a pure need up to that point where that individual is going to stop working. At that point in time, there's really not an income to cover. But man, the death benefit being in place at that point in time opens up unlimited possibilities of how they can now spend their assets into the future if that death benefit's guaranteed to be there. If that death benefit goes away, people are stuck in a box of how they can spend their assets into the future.
I'm glad you brought that up, and maybe this is a reminder. We've got a bunch of stuff to cover on this one. Maybe we won't touch on it now, but we'll bring you back for another one. But we need to bring or address your spend down strategy, which is addressing having that death benefit in place in that retirement phase, if I'm not mistaken. Is that correct?
Right. I mean, that's one of the huge benefits right there. So there's one example out of many, and it's the ability to spend down the assets that you've accumulated. Because what's happened is, if you look at the buy term and invest the difference idea that's been pushed on the American people, it was really in the best interest of the financial services industry, right? Because during the accumulation phase, if you think about it, the financial institution got to use all the money, right? Mm-hmm. So it's all socked away with the financial institution during the accumulation. Now, when this individual, if they bought into the buy term and invest the difference strategy, and now they've reached this age of distribution, and their term insurance is now expired, now they're stuck in a place where they can't touch principal. So they have to leave all that principal with the financial institution, and all they get to spend is that little bit of interest. And it's all going to be very stressful, because anytime the market moves, it's going to totally impact the amount of money they're going to be able to spend, because they know the golden rule is you can't touch principal, because if we run out, we're done. Yep. Now, let's look at the other strategy and think about it from this standpoint. What if we had whole life insurance along the way, and now it's guaranteed to be there when we die? Well, let me ask you this. If you knew that at some point in time out in your future, you were going to win the lottery, would that change how you spent money today?
Absolutely.
Yeah, right? Okay, so think about it in those terms. If I know beyond a shadow of a doubt that at my death, X amount of dollars is going to be poured into my estate, does that change my ability to spend the assets that I have now in a different way? It opens up, it's like a permission slip to let me use my assets in the most optimal way possible, rather than being stuck in that box that was created by the buy term invest the different strategy.
Really good. All right, let's move along. How's that sound?
Yeah.
All right. So myth number 2 is qualified plans are the best way to save for retirement. Remember, we only got about 45 minutes, Todd.
Well, here's the thing about the 401k. It's a tough subject from the standpoint of people are saving money, and that is a huge upside, because the people that are putting money in their 401k are doing more than what a lot of people out there are doing. So they need to be praised for doing that. The unfortunate thing is there are some pieces of that puzzle that were left out for most people, and they don't realize the impact of what's going on. Most of the time they were talking about in these terms of, hey, it's going to save you taxes. The reality is it doesn't ever save taxes. It postpones taxes. And for a majority of the people out there, they're putting money into the 401k when they're in lower tax brackets, which is going to automatically, just based on the distributions from those 401ks, push them into a higher tax bracket. So they're potentially deferring money into a higher bracket, even though they were going to told it's going to be in a lower bracket. And the unfortunate thing is there's been so much talk out there about this idea of being in a lower tax bracket when you retire, that we've had clients that literally think there's a separate set of tax brackets for retired people than there are for working people. And it's logical conclusion when you hear accountants and other people telling people that you're going to be in a lower tax bracket when you retire. To me, sometimes a client will say that, and I mean, this isn't very, it's in fun, right? It won't be because something we've done for you, okay, that you'll be in a lower tax bracket. We want you in the highest tax bracket possible. We don't want you paying any more tax than you have to. That's a different thing. But we don't want you in a limited tax bracket, because the only way to do that is because you don't have any money, right? That's what's going to get you in a lower tax bracket. So we would much rather see you in a higher tax bracket, meaning you're making as much money as possible. And if that happens, then now we're going to be deferring potentially into a higher bracket. So while there's some good around it, there's also some serious bad. And another big piece of the bad, we talk about and assets and or assets, with an asset that we have access to the cash to use it to take advantage of an opportunity of a lifetime or whatever else that comes along, that can be a huge, huge benefit. And in the 401k, that money's pretty locked up. And so it's pretty difficult to use it for something like that. So really all we can expect out of our 401k is really just whatever the 401k grows to. It can't really be in there to step in for an emergency, other things very easily.
Yeah. Let me add one thing, and I'm going to talk about your favorite movie, The Notebook, right? Here's something I'm going to throw in sprinkle some tax here as well, because this is a true story. I would tell you, when I was a CPA, or I had my CPA firm, I fell into that. Well, you're going to be in a lower tax bracket when you can retire, and I didn't learn the truth until actually it was my son's kindergarten teacher, and my son's 26 years old. But a few years ago,
still in kindergarten.
What now? But he still was a teacher, right? I mean, he's a little slow, right? Right.
Sorry, Vicky. Sorry, Sarah.
Yeah, and sorry, Chad. How about that? Okay. But her husband died, I want to say, when she was maybe 67 or something like that.
Uh-huh.
But one thing I didn't realize, and I think a lot of people don't, is that her income at that point stayed the same. I mean, because she had her pension coming in, she had her Social Security coming in, the money that she was coming in from her 401k and IRA, all of that's taxable. All of that stayed the same, but what changed was her tax bracket.
Right.
In two ways. For one, there's a larger standard deduction when there's two people. So her standard deduction got cut in half, but also so did her tax rates. It's different when you are married, you're in a lower tax bracket than when you're single. So not only did she mourn the loss of her spouse, but her taxes literally doubled. And so I know, Cameron, you're like, well, what does that have to do with The Notebook? Well, if you watch Cameron's favorite movie, The Notebook, if you haven't, I'm going to spoil it, okay? But at the end of the movie, the couple dies like holding hands, cuddling in bed, right? Which would be a great way to go, but odds are, somebody's going to go first. And that somebody who's left is going to have a huge tax bill, and also will be mourning a loved one. So having that death benefit, even when you're past 65, can help that surviving spouse pay that original tax bill as well.
Yeah.
Thanks for tying The Notebook in there. I was wondering, it took a while to get there, but we got there, right? One thing that I'll add in on this part of it is, right, we're talking about qualified plans, and we just talked about some myths, right? If we're gonna compare kind of the strategies that we use versus kind of the traditional planning, is I would say that we're comparing actuarial science versus assumptions. And so some of the assumptions that we just addressed were, number one is market performance. We're assuming that this thing is going to go up for us, and we're hoping and praying that it goes up for us. Number two is we're assuming that taxes are going to be in our favor once we get there, right, et cetera, versus building a strategy based on a solid foundation of actuarial science. Todd, now I'm going to kind of turn it over to you. You mind giving us kind of a working definition of actuarial science and how that plays into the insurance strategy?
Sure. The actuarial science, and it kind of plays into what we talked about earlier about the spin down. If we can, so it's leveraging guarantees against each other, really, in this case. So what happens is we can leverage the guarantee that we will die eventually, right?
Mm-hmm.
And the fact that when that happens, if we have a guaranteed event that happens at that same time, we can pull that forward in time and use those assets now instead of waiting until that future moment. And there's several different ways it can be done. And one of the big ways, like we said earlier, was being able to spend our exact assets now, knowing they're going to be replaced in the future in our death. So we don't disinherit our family or whatever else it is that we wanted to do with those funds. And we can spend them now. And we also have that to lean on into the future. But there's all kinds of other open pieces that we can use, again, by being able to leverage that actuarial science. The absolute pure chance of or risk or death into the future against that event of what's going to be poured into our state at that point in time.
Awesome. Thanks for touching on that. Myth number 3. Let's move on. Thanks. Myth number 3, moving on. What I've got here is the path to wealth is found in a well-diversified portfolio made up of stocks and bonds.
Yeah. To me, if it's diversified into stocks and bonds, it's not really diversified, is it? I mean, it needs to be diversified into something that's outside of that same marketplace, right? It would be a lot better if it was diversified into something that wasn't going to be impacted by the same events. You know, when we diversify from one stock to another, that's not really diversification. If something happens to the market, both those things are going to go down, even though they're technically diversified. The reality is, let's have some of those assets in a place that's not going to be affected by what goes on in the market or affected in a different way. And that's, to me, true diversification. So moving those assets to some non-correlated assets, non-correlated to the marketplace is what is true diversification in my book. And you're right. I think from that standpoint, if we understand it in those ways, then yes, diversification can be a plus. We start to mitigate the risk. It's part of what the insurance company does. It's part of kind of what we've been talking about a little bit. It's shifting that risk around. And when we look at that risk side, it's really important to be able to take on risk, I think, for people. I don't know, were you going to talk about uncertainty at all? If not, I'm going to talk about it now.
Yeah, dive on in. Yeah, go for it.
Okay. So one of the other principles that we have, and it kind of lays in the same grain a little bit, but it's the principle of uncertainty. And that seems weird. It's like, wait a second, that's a principle? Are you sure that's not the opposite of certainty? And no, it's actually a separate principle, because as human beings, we like a degree of risk. Certainty, pure certainty, is boring. Okay. So we have a life insurance policy. Why don't people just flock to it? Because it does what it's supposed to do consistently year after year. It's boring. Okay. Boring can be good, but boring can also be boring. Right. So how do we fix that? Well, we have some uncertain assets. We have some places that don't have pure certainty around them. You know, I think about it like this: a roller coaster. People like the uncertainty. They like to be scared. They like to get in a roller coaster, but they also like to put the seatbelt on, right? All right. So we look at a piece of real estate. Is that a certain asset? No, it's an uncertain asset. But we can look at all the paperwork and say, man, the numbers work out. Everything's perfect. But what happens if one of those uncertain things comes true that we didn't put into the calculations? A market change and people aren't renting anymore. We lose a roof and we have a huge capital expense. Well, as long as we've got certain assets in there, it makes the uncertain assets more certain. So it gives us the risk side, and it's been somewhat insured, or the risk has been mitigated by having those certain assets that may be boring. But if you think about it, it's those certain assets that made the uncertain possible without a huge risk. What I like to say is uncertain assets without certain assets is gambling.
Say that again.
Uncertain assets without certain assets to back them up is gambling. Whereas uncertain assets with certain assets to back them up, that's opportunity. That's where we risk and take advantage of potential opportunities out there instead of it just being a crapshoot. And I think a lot of people we see, oh, well, this guy didn't do this. He didn't have these certain assets. He got lucky. Well, that can happen. But the chance of it's very, very slim, okay, without being able to shore the upside. And most businesses got to where they are because they understood both sides of that.
Awesome.
I think I know, Todd, you're a very busy man, and then I know we have about 20 minutes left. All right, so let's kind of do a little fire.
Okay.
Fire question by fire.
Rapid fire.
Thank you.
Uh-oh.
Okay, which will be honestly, Todd, man, I feel like there's so many questions, and even going through this, I even wrote down some other myths that we would love to take. So maybe we'll have you back for part 2 of the.
We'll
myths.
love to.
Now the next one I've heard, and I even heard this from my ex financial planner. Whole life is a terrible investment.
Right, and that's what you're going to hear from a lot of people who don't understand it or have never looked at it in the right light. And the point is, it is a terrible investment if we want to compare it to investments, because life insurance really is not an investment. It's a savings vehicle, and it needs to be kept in those terms. We need that saving aspect. Why do people have money sitting at 0% or 1% at the bank? Because they need that access to cash, right? They need that savings portion. That's what the life insurance takes over, and yet it's at a much better return than having it just sit at 0. And it also provides the death benefit and those other pieces along with it. It becomes an asset that handles multiple pieces all in one. And so, it's taken out of proportion. People want to compare the return in a life insurance policy to put money in the market at 12%, even though they're only doing 3%, but never mind that. So it's the wrong conversation. It's the wrong asset.
I love your response when I've heard you on stage. You always say, compared to what?
Yeah, and that one came from somebody else too. So, but that's one of my favorite questions. Absolutely.
What else you got?
That's Daniel Pink. I need to give him credit for that. So.
Okay.
Thanks, Daniel.
Yeah.
Well, I mean, also I will quickly add that the way we structure and the way life insurance can be, and you alluded to, that this is an and asset, which I heard you explain earlier. Do you want to expand on that a little bit?
Sure. The thing about it is, if we have access to cash, the upside is infinite. We don't know what the upside has the capability to do. And if we can shore up the bottom end and realize, okay, this is our emergency opportunity fund, if we can think of it in those terms, then all of a sudden we've got a place that covers our emergencies without it being a cost. And I think that part of that is the difference between safety and certainty. I don't like the word safety because to me, it's more defensive than it is offensive. Certainty to me is more offensive. And so when we talk about safety, it's like we have a cost in order to get something. If we have certainty, that's a different animal. And I think that when we look at a life insurance policy, it provides certainty. It provides that emergency fund without it being the cost of an emergency fund. Instead, it's also our opportunity fund. So when that deal of a lifetime comes along, and let me ask you guys this, why typically does the deal of a lifetime come along?
Somebody needs money.
What's that?
Somebody needs money.
Right. Somebody needs cash and they need it now. They can't wait until next week. Okay, if we're in a position of cash, then we can take advantage of that opportunity, right? And so that's the beauty of having a life insurance policy is it can sit back there and coast, and because it's an and asset, I can use it as long as I do it in the right order. I need to buy the life insurance policy first before I buy the opportunity. Otherwise, if I stick it in the opportunity, now it's an or asset. I stuck it there and I can't do anything with it but that.
Yep. Earlier you were just talking about comparing it to, pick any asset, right? But you said the stock market. And a lot of times somebody wants to compare the performance of life insurance to the stock market. And what helps with an understanding when talking to an advisor is, listen, we can do both. right? We can put money into life insurance, and if we view the stock market as an opportunity, then we move into it. Or if we view or we find that once in a lifetime opportunity, which may be a rental property or something else, then we move into it, right? So there's an understanding there that that a lot of people miss the first time around with this concept that they do need to understand.
Yeah, it's really an ordering issue as much as anything else. It's what order I do it in. If I put it in a place where it's stuck first, then I'm stuck. If I put it in the life insurance policy first, I can still do those other things that I wanted to do, whether it be, like I said, real estate or the market or whatever else that opportunity comes along. But it doesn't hurt me to sit and wait either. It's still sitting there crunching along while I'm waiting for that opportunity to come along.
Yeah, I've heard, and I stole this from Kim, right? Is saving versus investing, right? Is the saving is a verb where you're actively putting money into an account, and then the investing is that opportunity that comes up. They're two distinct actions that come along, whereas a lot of people kind of put it into one, and now you're very subject to volatility, market, and everything else.
Right. Absolutely.
We've got, all right, so real quick, next one is myth. Paying cash is the best way to make a purchase.
Yeah. Yeah, that's a huge myth, and it's hard for people to understand that piece, probably more than anything else. It's the old thing. My great grandfather taught me the only way to buy anything is 100% down and nothing on mine. I just pay cash, so I don't have any costs in interest or anything else. And the reality is, I love Nelson Nash's line, and that is, we finance everything we buy. And it's absolutely true. It doesn't matter whether we pay cash for it or whether we finance it with a lending institution, we're still financing it. The difference is when we pay cash, it's harder to see the impact of how much damage it's done. A friend of mine in Louisiana says it this way. He says, you either pay up interest or you pass up interest. Pretty straightforward, but that's what happens when we pay cash, isn't it? So if I finance something with a lending institution, I can see the interest that I'm paying. What I don't see is when I pay cash, the interest I'm not getting. But it's the same thing. The difference is when I pay cash, I'm really financing what I'm buying with my future retirement assets or distribution assets. And that is hard to see until I get to that distribution age and realize, wow, I paid cash my whole life and I don't have any money. Right?
What's funny, Todd, is when you talk is you give examples, and I think of calculators that I would use to illustrate this, right? And so, an example, you're talking about what I believe is the time value of money or opportunity cost, and so we would be using the borrowing strategy in there, right? And so that's one of the big. You're shaking your head. Go ahead.
Yeah, no, you're right. And I think the automobile purchases really shows that pretty straightforward. That automobile purchases calculator really lays it out of, hey, if I switch gears and take the, some of the Dave Ramsey strategy and just pay off my debt, and I don't have any debt, but I don't have any money either. So have I really gotten ahead?
Yeah, this is, using that borrowing strategy is one of the things that we always talk about is math and money are different, right? And in school, what we're taught is we're taught math, but money behaves differently. And so,
yes.
Right, that's one of the things we're able to use. And again, maybe that's a bigger conversation on another fallacy or another myth, is that that's what a lot of financial plans, quote unquote, will miss when they're talking about financing equipment and paying cash for it.
Yeah, and it's a hard place to move because the issue is we look at the financial industry and it's about math, right?
Yep.
But that's only a small guideline of where the direction is. And it's exactly what you said. Money really is, it's not all math. There's so many other pieces. How do you, if we just do a math formula, how do you calculate in there the erosion that happens with time of that money sitting there and inflation working on it or missed opportunities or all these other pieces that have to be in the conversation? And what it comes is something much bigger than what a lot of people are asking, and that is, what will this grow to in 20 years? And the pure answer is, I have no idea, right? I mean, that's the only real answer.
Sorry, Anthony and I were arguing about which question.
Yeah, we got,
We're
yeah.
fighting over questions. Like, no.
Throw them twice. I'll talk faster.
Let's do it. Ready? Yes.
Best out of 3, right, Todd? Yeah. Okay.
All right, Cameron wins once again. All right, so Todd, that absolutely solidifies the fact that you've got to come back for a second interview. So we just Rochambeau'd and I won, and so we're going to ask my question here to wrap things up.
It's still a good one. Not as good as mine, but
we have just a few minutes.
Sure.
And, well, your question is really good, but it's going to be a broader, longer question, so we need to give it its due time, deserved time. But the question I want to ask is, Todd, what are your thoughts on direct versus non-direct recognition companies, and quote unquote, which one is better, right, between the two of them?
Okay. So here's the thing. When people argue over that, what that usually tells me is they really don't understand what the two things mean. It's an unfortunate piece that people use that as a reason to do this or not do that. Direct recognition is just a method of calculating the way the interest is handled inside of a life insurance policy. So let me give you a quick overview. And the thing about it is, if a company has a fixed interest rate, they are always going to have a direct recognition loan contract. They have to, because what could happen is if a company, let's say, had a fixed 8%, where does the money come from?
Let me just clarify for Cameron, is that when you mean that interest rate you're referring to is a loan, is an interest rate on the loan?
That's correct.
Okay, it's not the growth of the cash value, it's a loan interest.
Right. It is the loaned portion that falls under the direct recognition or non-direct recognition information inside of the life insurance policy. And so literally what it means is a direct recognition contract directly recognizes the loan. A non-direct, the loan, the borrowed funds inside the policy have no effect on the dividends or anything else of the policy. It's not directly recognized by the company as far as the way it's treated on its earnings. And so what happens is when we have a fixed interest rate, the money has to come out of the general fund in order to pay those loans. And that's the same place the insurance company does its investment. So if money comes out of that portion, it would literally impact everybody's dividends, right? Unless the insurance company is charging interest on that loan to replace that just as if it was out invested elsewhere. And that way it keeps it fair for all the policyholders. So what happens is if a company has a fixed loan rate and the portfolio rate gets up to be higher than that loan rate, then all of a sudden there's a problem because the insurance company isn't getting as much money on the loans as they are on the portfolio. So now that all the policyholders are going to suffer in their dividend because somebody else took a loan. In order to fix that, the insurance companies have a direct recognition contract whenever they have a fixed loan rate. And it allows that the person with the loan gets a certain amount of dividend instead of being open to the full amount. Now, it could be more and it could be less. An example right now, just quickly on the direct recognition side of a company that has an 8% loan and their dividend is treated as 1% less than that for that particular person. So that means they get a 7% gross dividend if they have an 8% loan, right? Well, the general contract, because dividends are where they are right now and interest rates are low, is only at 5.5%. So the person with the loan on the direct recognition is actually getting more money in that scenario than everybody else is on the loan. And how can the insurance company do that? They can do it because they know they're getting 8% in, right? And because of that, nobody gets hurt. Everything's the same. Now, if the portfolio rate was higher or the dividend rate was higher than that 7%, then anybody with that loan would be getting less than everybody else. With a non-direct contract, you're always going to see a variable loan rate. And the reason for that is so that loan rate can vary with the portfolio rate to keep it fair. So there's not really that one's better than the other. It's just different. It's just the way to handle it. To me, one of the main jobs of an insurance company is to keep it fair for everybody. Okay, and that's what they're doing. They're making sure that the people that have the loan are paying for the loan and not all of the policyholders. And the reality is, in a non-direct, it could get out of whack. The direct recognition never will, because of the way it's structured. In other words, the people who have the loan will pay for the loan, not the rest of the policyholders. There is a possibility that with a non-direct, which everybody touts as being the best, it could actually get out of whack to where the insurance company isn't getting as much on their loans as they are on the portfolio rate, because they can't adjust it as fast as the portfolio might. It probably won't. And over 30 years or 40 years or 50 or 100 years that we have our policies, it's all going to be irrelevant. We make a mountain out of a molehill a lot of times.
Right. Yep.
You know, a wise man once told me that there's no deals in life insurance. Right? So, and this just goes right back to it. I mean, there is no deals. They're using math here.
Yep.
Using, money math and actuarial science. There is no deal, right?
That's exactly right. If you can remember that, it answers the question for almost everything else.
Okay. Todd, I wish we had more time. Because believe me, I got this killer question that I'm going to be bitter all weekend, but
Because he lost.
yeah, because I'm going to work on my Rochambeau over the weekend.
You just need to do better with this, and then you'll be good.
Exactly.
The listeners can't see it, and which is probably for the best. Okay. Todd, we want to thank you for taking your valuable time, and for our listeners to kind of go over these common myths and untruth about money. And we would love to have you back.
I'd love to be back. I really appreciate what you guys are doing, getting people educated. There's, where the misinformation comes from is people with an agenda trying to sell whatever it is they're selling, and they leave stuff out, and it just takes a little bit of, you can even prove things mathematically that aren't true based on having incorrect facts in your calculations. And that's a lot of what we see. So the more we can get this out there, the more we can educate people into the way things really work. Because the biggest thing that I want to see is I want to see people empowered to make their own decisions. And that's way different than what most of the financial industry preaches. It's more about do what I say because I know what I'm telling you is best for you, instead of teaching your clients how money really works so they can make those decisions and see through the BS.
Okay. Todd, I'd also like to thank you for all that you do for these other advisors, particularly in the prosperity economics movement. Like, we all use your calculators. We've been to the training. We've seen you speak at a think tank, and I know you and Kim do a lot for this industry to unveil those untruths. So thank you for your time and expertise.
Well, thank you for your participation and your support. It's a passion of ours because we love this industry and we'd hate to see it fall away. So hang in there, fight the fight.
Okay, perfect. So Todd, thank you. And for our listeners, go make it an awesome day.
Take care.
Cool, thanks.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.